All right, what you're looking here is called the option chain. And so this option chain has different expirations like we talked about before. And so you can begin to see them. Like right there, that's one. That's 2 days, expires in 2 days, expires in 16 days. We even have one that expires in as long as 842 days, which is about 2.5 years. And so the reason we call this a chain is because it is a list of different expiration dates. And then if you notice, you will see that you have an arrow next to the dates. And when you click on the arrow, this arrow will actually expand. And so when it expands, it shows you the different strike prices or the different costs of that particular option, whether or not you're buying or selling that option. And so now what you have here is you actually have the expanded options chain. And you can see that has some of the same information, but also different. So now we're still looking at the date. It is still the same date, October 24th of 2025, which is the expiration. But then to the next, you have the strike prices, which is the 98, 99, 100, all the way to 105, which is what we talked about. So this is the price, the line in the sand, which you are saying, hey, I want my stock to get above this particular price. And then you notice you have the bid and the ask on the left side, which is the call side. We haven't talked about that yet. That's the next lesson. And you have the bid and the ask on the put side. So I want to kind of explain this just a little bit. So imagine that you are buying a car. You go in there and you are saying, hey, the dealership is asking you to pay $20,000 for this car. And you're saying, no, I don't want to pay that much. And so you bid $19,000. And the dealership, kind of meets you in the middle, and they might say, well, let's do 19.8. And so you have this whole debate going on, or like an auction where you are bidding a price and they are asking a price. And so it's the exact same thing inside the stock market. The stock market really is just a big auction. You have lots of buyers and lots of sellers. And so there's the stock option contract. And then the question is, what will you actually pay for this? And so they ask you to pay something and you bid something. Now, whether or not they accept it is a different story, but that is the way that the bid and the ask work. So if they're asking, that's what they are selling it for. The bid is what you're bidding or willing to buy the option for. All right. Now I'm going to be a little bit repetitive in these next couple of slides, but I want to really dial in and clarify every something so you can see it, understand it, and hopefully it makes complete sense. So you have this big group of numbers and letters, and it makes no sense to you. Well, what it is basically the options chain just broken down. When you actually put the order in, this is what an option chain symbol looks like. So you can read it. TQQQ is the actual stock symbol. That is the stock that you're buying. Now, it could be any stock. It could be Apple. It could be Google. It could be SoFi. If you ever heard of SoFi, it could be any ticker. It can be AT&T. But that's what it is. And the next group of numbers is the actual date. So 25 is the year, 11 is the month, and 07 is the expiration date. That's the date that it actually expires on. And so then after that, you have the P. Now this P can either be a P or a C. That tells you the type of option that you are buying. Either you're buying a call or you're buying a put. And so in this case, you're buying a put. And the last thing you have is the strike price. And so the strike price tells you the line in the sand that we've been talking about this whole time of where you want your stock to get above so that you can make money or have appreciation from the option contract that you purchased. So what you're looking at here is actually another option chain from a different broker. The first broker we looked at was Charles Schwab, and their platform is called Thinkorswim. And this one is actually tastytrade, which is just like I said, a different broker. So you're still looking at the bid, the ask, the expiration, which is November 7th of 2025. The strike price, the line in the sand is $50. And you look at the call side versus the put side. So remember that we said that everything is times 100. So when you actually look at the prices, you're looking at the bid is $5,160. The ask is $5,560. And then the put side, you're actually looking at $8 versus $30. So It's all the same stuff. I just want to give you another example so see if it made sense to you or give you multiple ways to actually see it. In our next lesson, we're going to actually look into contract specifics. What is a call? What is a put? And I think you're going to really enjoy that. So let's keep pushing forward.